If you're thinking about buying a condo and you're not paying cash, you'll need to figure out how you will finance your transaction. And when it comes to financing condos, lenders will order a condo questionnaire and the condo association financials. So after reviewing that questionnaire, after reviewing financials, here are the common issues associated with condo financing. So first, what's the financial stability like? The big thing that comes up on the budget, reserves. Are they adequate enough? The next issue is the delinquency rate for condo association dues, the monthly fee that every owner pays. If that number is greater than 15%, that'll be an issue for financing. Next, is the condo association involved in any litigation? Often this involves some type of construction defect or dispute with contractors. Next, is there adequate insurance? There needs to be hazard insurance, liability insurance, fidelity insurance. Next, what is the age and condition of the building or buildings like? There was a big construction boom for condos back in the 70s and 80s, so those buildings are now 40 and 50 years old. Certainly time will have its effect on everything. Now when it comes to age and condition, something we will often see are special assessments for repairs, for improvements. And if the special assessment is already in place, well, the remaining balance will typically transfer over to the new owner. But if it's pending, the association could still be figuring out exactly how much the repairs, the improvements will cost. Until that's complete, it's going to be difficult to get financing. Next is the concentration of ownership. If one entity owns too many units, that'll be a problem. Because what happens if that entity runs into some type of financial distress and they can't pay dues, or they fall behind on mortgages and there's a large number of defaults in the building? Next is the owner-occupied ratio versus non-owner occupied. That can be an issue depending on the transaction. Next is commercial space. Now, there are many condos out there. We find this a lot in the cities where it's mixed use. There's commercial space on the first floor, maybe restaurants or gyms or professional offices. But if that commercial space exceeds 35% of the square footage, that'll be an issue for financing. And lastly, if the condo is being operated as a condotel, we see this a lot in resort communities, a high-rise condo building, and there's a rental desk on the first floor, maybe a concierge if there's daily cleaning services, there's daily rentals taking place, that won't be allowed. So all these things I just mentioned are issues when it comes to Fannie Mae, Freddie Mac, Ginnie Mae type financing. Ginnie Mae is FHA and VA and USDA. Hopefully the condo you're looking at is already approved. If it's not already approved, the lender can submit for approval. For example, FHA has a approved condo list. If it's not on that list, the lender could submit for SUA, single unit approval. If ultimately the condo won't meet the requirements for Fannie Mae or Freddie Mac or Ginnie Mae type financing, the alternative is non-warrantable financing. We find that under non-QM, non-qualified mortgage products. And when you step outside the box, so to speak, when it comes to Fannie Mae and Freddie Mac and Ginnie Mae financing, what you can expect is a higher interest rate and a higher down payment. So if you're looking at condos, take this all into consideration. If you have questions about condo approvals or questions about condo financing, if you want to connect with me, just click on my link tree.